When we were getting together for our session, we were talking about how portfolios were coming back, and there's some percentages out there in the high 50% range or higher than we've seen the last couple of years. Are you seeing the same thing in the work that you do?
Yeah, we have. When you look back over a 10 or 15 year period, the evolution of the portfolio continued to grow and grow, as a percentage of total transaction volume in a given year. And in sort of the peak of 2020 and 2021, where there was a lot of new entrant capital and the ability to grow and scale through portfolio acquisitions, really pushed that up into the 50 to 60% range. And then as 2022 hit, capital formations sort of started to deplete. The choppiness in commercial real estate and capital formations, really took an impact. That fell down to 5 to 10% of the total transaction volume, and candidly, even the portfolios that did sell were much smaller. Fast forward though, you look at where we are, on a multi-year basis, right? Disruption started happening in early to mid 2022. We're now 4 years later, and the fundamentals have proven to remain very, very strong. I think the discipline and the business plans of institutional investors and some of the household names in medical office have remained very focused on medical office. The IRA team can attest the same. When you look at a multi-year deployment into medical office, a lot of allocators are under deployed to medical office. Meanwhile, fundraising has ticked back up. The public markets are at all-time highs. Maybe not today and yesterday, but on any given day, we're near highs in the public markets, and so allocations of the largest allocators of capital, state pension plans, teachers' retirement systems, are pretty high, and so the appetite for large-scale deployment, has really ticked back up.
Samir, how do you think about that?
So I guess I'm a live case on portfolio buying because
Right.
we just closed on 2 portfolios in the last 30 days. Historically, IRA Capital, we would buy one-off transactions and create our own portfolios and exit. So, early on we were buying individual assets, creating value and selling 3-asset portfolios, 5-asset portfolios, and that started growing to 19-asset portfolios. And then in 2021, at the end of 2021, we sold a 31-asset portfolio. But each of these assets was compiled individually, right? So we were literally buying one-off assets and creating these portfolios and selling to institutions. Fortunately, we sat on the sidelines on 2022 and 2023, but we came back in 24 pretty strong, and we kind of changed our entire mindset. Instead of buying one-off assets and creating portfolios, we thought there was always a portfolio premium on the exit. Over the last couple of years, that changed, and so we were out hunting for portfolios because there's a portfolio discount, because capital was difficult to find from an equity perspective and a debt perspective. And so in 2024, we bought 2 large portfolios, and then just in December of 25, we closed on 2 large portfolios because it's easier now that we have capital behind us, both from a debt and equity perspective, to put out a lot more capital that way and more efficiently. And it's tougher for the larger institutional buyers over the last 2 years to sell things of size other than some of the things we've seen over the last couple of months.
Great, thanks. Brandon, how about you?
I just want to comment on a couple different things. I think that with the run-up in interest rates, the marketplace generally just wants predictability to be able to be efficient. Whenever there's choppiness and they know rates are going to continue to go up, it's very tough for those capital allocators to then say, now is the time to deploy. So yes, there was some shuffling of the deck. There were new capital formations that have now come out of that. But the benefit of what has transpired over the last, call it 36 months, is our space has been highlighted for the fundamentals that I think everyone here agrees are pretty much as sound as ever. And secondly, we're finally at a point where it used to be where we were so far above replacement costs when we came to bring up assets to market. Now we're actually well below replacement costs, so there's even more stronger tailwinds to push mark to market across the assets to help enhance returns. And in large part, the biggest needle mover within the marketplace kind of shifting on the kind of more off switch and the volumes dropping down is really the debt markets. So debt markets, in the peak of the market, we all know that interest rates were next to zero. Your spreads were mid 100s for credit. When the interest rates shot up, banks are the most conservative people in the room. They quickly gapped out to north of 200 bips spread on typically what we see in our space is SOFR swaps. And so it became, and not only that, but also the size before they would then syndicate. And the way that it kind of works on the syndication market is the last bank in sometimes determines what the overall last spread will be. So there was some retrading that happened at the end of a transaction that impacted the returns. So those that brought larger transactions to the marketplace did it more or less out of necessity. And we also saw a lot of seller financing just because to kind of assure the execution on the transaction. Fast forward now to what happened in 2025 is, with the final rate cuts kind of really settling in with these new capital formations and the lenders willing to kind of participate, we saw spreads from beginning of last year going from low 200s for investment grade credit to now, fast forward today, mid 100s. And the check size for single holds went from 75 million to now 250 million really plus, which has opened up the avenue from all those that had aggregated and did not find a point of liquidity over the last 3 years to finally have an exit point. And we also saw for well-curated thematic portfolios, I think we finally have started to see the creep back in of the portfolio premium. And what does that mean? That means that the individual assets probably would price at a higher cost of debt than with the portfolio in its entirety. Why lenders like it is its immediate diversification, it's a larger check size, and typically the investor standpoint that makes it for Samir and the broader IRA team and many other portfolio buyers is they're able to enhance their returns from that better debt metrics. And so I think that this now, and some of the data points that we did with the Cleveland Clinic last year, with the upper fives cap rate, low sixes on the bonds accords, is these are kind of that threshold to release a lot of the other operators to kind of bring some deals to market. So we should see the volume here follow suit in 2026, and I think the broader sentiment is rather bullish.
Right. So Michael, from the public perspective, how are you viewing this question?
Yeah, I mean, clearly in the private markets, we've seen a return of transaction activity in portfolios. But on the public side, it's a bit different given how the public market has viewed these medical office portfolios. They're valued at pretty significant discounts relative to what we see in the private market. And so as a result, you're seeing the big MOB owners in the space, the health peaks, the healthcare realties, they're all largely selling, call it $1 billion plus assets. Some of them are, it's all broken up into individual portfolios, but they're largely selling assets in order to capitalize on that stronger private market bid. And so it's a bit different in the public market just in terms of how they're viewing it. And unless there's a complete sea change in terms of how the public market values these real estates, I wouldn't anticipate that really being a bidding source within medical office.
Right. Go ahead, Ben.
I was just going to say, the private markets clearly value healthcare real estate, medical office buildings in particular, greater than the public markets do, right? And that is translated into a pretty significant amount of consolidation in the REIT space, whether that's through M&A or portfolio sales. It's translated into what we've seen in the last 12 months, and I think what we'll continue to see over the future 12 and beyond is some pretty significant sized transactions, and then subsequent transactions off of that, right? Because it's all top down. You're going to see, I wouldn't be surprised if you saw 6 or more billion-plus transactions this year, right? And that's going to catalyze a significant amount of transaction volume, not only, as we were talking about portfolio trades relative to total, but then also, sub-portfolio and sell downs beyond that. So I think it's really a massive catalyst to the entire market.
Yeah, I think what's happening right now, our philosophy is pretty simple. Like, to really simplify it, when the REITs are trading high, we're usually selling, and when they're trading at negative NAV, we're usually buying, right? So it's just, we play the REIT public-private trading game. And if you look at today, most healthcare REITs are looking for growth, and a lot of them have been trading at negative NAV. So they're chasing growth. Where do they find that growth? Most of them have been moving towards senior housing, and we do a decent amount of senior housing as well. You're getting 8-10% top line growth, expenses is stabilized. And so when they're trading, and if you look at any of the public REITs that are in both seniors and medical, if you look at what the medical is trading at on a cap rate or is valued at versus the senior housing, the discrepancy is just so massive. It doesn't make any sense to be putting money into a stable growth, 2 to 3% annual, rent bump like medical versus a 6 to 8 to 10% growth you're going to get out of senior housing sector. So that's why we've been seeing that the publics have been having a lot of desire to move assets, either because they're trading at a negative NAV and they can't raise capital, so they can't buy anything, and or if they have capital, they want to take that capital and then re-inject it into senior housing.
So Samir, what are you looking for when these guys bring you a portfolio? Are you helping them decide what you want, or are they kind of know what you want and they're bringing it to you?
Yeah, I think it's both. And we are very fortunate because capital raising has been difficult over the past 3 years, 4 years. So frankly, in 2024, we at IRA were like, we're going to go raise our first fund. And we had done $3 billion of acquisitions, and we decided to raise our first fund in probably the worst environment. And we had phenomenal meetings. Everyone loved it, loved our track record. But to get that first 50, 100 million was really difficult. And we felt like we would be able to get the rest, but getting in that first check was difficult. And we were seeing deal flow coming so fast with sellers that had to move. So we said, you know what, we're going to go back to our joint venture status. And we ended up doing quite a few deals with different institutions as a JV. And then last year, we were fortunate, we brought on CPPIB, the Canadian Pension Plan, and then another extremely large international institutional investor. And everybody has a little different desire on what kind of assets they want. So it's been conversations with these guys about, they're telling us, here's a portfolio we have, and then we're kind of crafting that with what we need and pulling out some assets, adding in some assets, but kind of, they're listening to what the sellers need to move. And at the end of the day, we just picked up 40 assets in the last 30 days. I would say it's a 20-30% deviation from what the original portfolio looked like. Mm-hmm. That's us taking some assets out and asking for other assets, and that's the seller saying, hey, we have to move some of these assets. So it's a combination of both sides.
I think there's two key themes in what you just said, from my perspective, right? It tells you on one side where there's an ability to, swap in and out assets. It tells you you've got managers that have a lot of product that's ready to sell, right? Because there's a buildup over a multi-year time period where these dispositions would have occurred, and the capital markets were not accommodative yet to it, right? So there's product pent up to sell. If you're not in that situation where you're able to sort of be malleable in portfolio construction, I'm sure you guys are doing the same thing as intermediaries, spending a lot of time on the front end with portfolio owners on construction, right? So if it's an asset sale, it's about construction of the portfolio. If it's a joint venture, it's construction of the portfolio, and positioning of the manager, right? They're both critically important, for your approach to market, right? The environment is a lot more liquid than it has been for a few years. However, you can't just throw a whole bunch of stuff into a portfolio, call it core plus, and expect that it's going to that it's going to trade anymore, right? You need consistent themes, and you need sort of thoughtfully curated portfolios.
No, I think it's part of just the thawing out of the marketplace from those that go to zero transactions and then saying, okay, we're going to step back into the market. The ICs that you all have to go in front of are rather discerning. And so they want to make sure that it fits the right box for them, because the capital raise was so hard. You want to make sure that you're hitting the mark for your investors, because you don't want them to all of a sudden then turn it off and go to another potential operator. And so we always kind of view it that we like to meet with be advisor from the birth to the death, that basically saying, or rebirth if it's a recapitalization, that going through portfolio construction, looking back at historical portfolios and metrics, and really kind of putting a score to that and rating them, is that the marketplace tends to be predictable, especially when you're doing the more recent ones. But I couldn't agree more that it needs to be well thought out. Throwing out to the market a just shotgun approach, you're going to have to move some pieces around to get the transaction to come to fruition. So why not just be thoughtful out of the gates, and that way you can kind of get a little bit more attention from the marketplace.
Good. Is there anything else on portfolios you think we should cover that we haven't, that would be interesting to the group?
There was maybe a large portfolio that traded at the end of last year.
You guys are happy to talk about it. Yeah, I mean, talk about some of the large ones. And I know, Ben, you mentioned there's a bunch coming up in 2026, which is pretty interesting. And we see it in our business too, because we certainly own healthcare real estate, and there were a few years in some of our earlier funds where we just we couldn't sell,
right.
And now all of a sudden, what LPs want right now is distributions. Because they've been so pent up, and they need to keep bringing some cash in, and so your comment was very apropos. So
yeah, look, I think a lot of those will eventually be announced, but directionally, what I think is really important is that the business has become so mature that you've got institutional capital of all shapes and sizes that have been, and domestically and offshore, that have been studying U.S. medical office for a variety of time periods. It could be 5 years, 10 years, 15 years. So the white papering, and candidly the white knuckling over what the right entry point into the sector is pretty deep into that process at this point, right? And so I think you're going to see a lot of new, really interesting, large-scale capital come in, again, right? We saw this, at scale in 2020 and 2021. I think it's going to happen again, right? And it's only going to buoy everyone that's already here, right? Because it brings more liquidity and more optionality to everyone that's a participant.
I think that's a good point, because from all the capital discussions we've had, the difficulty was always that we've been lumped in with office, right? And so when you're going to large institutional investors, you're lumped in with office, and then once you break past that, then it's getting them comfortable with price per foot, and then getting them comfortable with rent growth, and getting them comfortable with how much CapEx and TIs are going into these buildings, and convincing them it's all worth it because of the stability of tenants and the credit strength of these tenants, and how often they're just staying put and you can renew without having to put much dollars in. And everyone loved the story, and they're like, okay, we want to put $500 million, $1 billion of equity. Well, there's nothing of size to do that, and that was always a problem for so long. So many of the larger institutions we talk to, they're finally coming down on what that equity check can be, from $500 million to $250 million to $100 million. And that timing worked out for us and everybody here really well, because that's when traditional office just took a dive. And when traditional office took a dive, it's like, okay, we have to reallocate the capital for these sectors. And that's when MOB now started becoming a really good alternative. Now, some institutions are still putting medical within traditional office. and these are some of the biggest pensions out there and so forth. So we've been banging them over the head like, guys, this is a very different asset class. But you're starting to see that trend where many institutional investors are being forced to now reclassify it because they need to pull that money out of the office bucket that would have normally gone there. And so where are they going? They're going into data centers, right? They're going into medical. They're going industrial, but obviously industrial is having some issues here and there. But data centers and medical and seniors now have become kind of like the three hot names. Data center transactions are massive. So those are, you're writing $1 billion plus checks. Seniors, you can still write very large checks because, you know, one facility can be 1,500 million. Medical is where we were still struggling with trying to get those larger portfolios. But these last 12 months have really changed that. And so we're seeing a ton of new capital that's going to come in. And to Ben's point, I think that's going to help bring valuations up across the board. Because if you look at the discrepancy between where the REITs are trading on a cap rate basis versus where these guys are selling individual transactions on a cap rate basis, that spread is pretty wide. And I think we're going to start seeing compression on that across the board.
Yeah, I think on the capital raise side, you know, just sector agnostic, big increase from 2024 to 2025. And let's be honest, the alts have finally kind of shown their way. You know, it's no longer just the big four. That a lot of the demand has certainly been data centers is number one. They're extremely large check sizes, and from what we're hearing is that that's actually more capital raised for that than can actually be deployed for it, and that's also getting a little frothy. So then the number two from the demand side, from the you know, institutional and pension funds, is healthcare. Healthcare does get looped in, as Samir just said, with the seniors housing and medical. Yes, and to the earlier point about the public markets and where the valuations have been kind of more favorable towards the seniors housing, and because of the larger mark to market on a pretty steady annual basis. Healthcare certainly is a little bit behind from that, but the beauty is just how resilient we are.
That's right.
That seniors will be overbuilt. There's next to no barriers of entry to build seniors. You don't have a drag on the school system, and it's just a net tax positive to the municipality, and it's all done spec. Yep. So you have a good runway,
That's right.
a foreseeable runway with the silver tsunami, but you also have a great runway on the outpatient medical. So I think if you're going to be invested in healthcare, you need to be invested in both.
And I think people have finally actually recognized the resilience, right? Because seniors has gone up and down, and many people have lost a ton of money. Whereas in medical, we don't really have asset level distress, right? Yes, some of us bought in 21, 22, 23, and we paid a 5 cap for a deal. And yes, today that's not worth a 5 cap, it's a 6 cap. So if we have to refinance, you have some issues. But you don't have tenant level issues. You don't have cash flow issues. So it's really kind of kicking the can down the road on some of those a little bit longer until you either get enough rent growth or fill up some vacancy and or rates move, which we don't anticipate in the near term moving, but in the longer term there could be opportunity. But that being said, there's really no asset level distress in our industry, and people are recognizing that from an institutional basis. And so as that capital flows in and as these REITs need to recycle capital and more portfolios come out, I do think this is going to be a big year for portfolio sales, recapitalizations, people reshuffling their allocations internally between all the various asset classes. And if you look at where stock prices are, and now they have to reallocate more capital in real estate because they're getting short on real estate and then more towards alternatives, I think this is going to really help our industry over the next 12 to 24 months.
No, you hit on it with the denominator effect. That certainly does impact and is to our benefit. The other thing is that as we continue to become more and more sophisticated and mature in our sector, I mean, we could probably go through, it's all the people you were meeting with, but all the large investment managers, we continue to check more boxes of those that are investing in healthcare.
Yep.
And so the more that we can kind of get that institutionalization of the largest, commercial real estate investors in the entire world, the better we're going to be. And we also saw a flood of foreign capital.
It's a follow the leader mentality, right?
Yeah.
They see their buddies do it, and they got to
A little
do
bit,
it too.
yeah.
Yeah.
I've got some interesting statistics from PERE that build on everything that you guys have been saying. So in 2025, all institutions, when I'm talking about institutions, I'm talking about pension funds, endowments, all the big, the big investors. 63% said they were underallocated to real estate, and 11% said, or 21% said they were at target. So that's 84%, which is a really good number, that are investing. They're either investing the same as they were, or they're underallocated and they have to invest more. And then in 2025 too, the same investor group, 58% say they'd maintain, and 11% say they'd increase their allocation to real estate. So all very positive signs versus the last couple of years. And then if you look at 2026, so kind of their going forward view, which is what we're all most interested in, 45% say they'll invest more, 38% say they'll invest the same in real estate. So again, that's an 83% number. So again, very positive, supports all of this. And then when you start looking into the individual asset classes and sectors, and it's already been mentioned. So people who are going to invest more in 2025 are going to pursue multi and data centers at 32%. So that's not surprising. Industrial at 30%. Retail is kind of a surprise. It's coming back a little bit in the 20s. But then, healthcare's in there at 17, 18%. It's the steady eddy. It's the bedrock of people's portfolios. And then, but I think what's interesting about this data is the do not invest category. So 28% is office. 24% is retail, 19% is data centers, and 16% is healthcare. So again, it's more towards the bottom. So it really suggests that people view healthcare very, positively. It's a resilient defensive asset class. And if you group in seniors, you get a little bit of alpha. And the medical office gives you the beta that investors want, especially after these last couple of years. So, thoughts on any of this?
Maybe just on the initial point you made on allocations improving. I think negative leverage was clearly an issue, even this time last year, just given what's happened with base rates and credit spreads coming in. It's going to be easier for capital allocators to put money to work today. And then maybe just, a couple of the sectors that you called out. We already talked about seniors. I don't think the demand from investors can be overstated there. That's where I spend 80% of my time in conversations with clients, just given how many new entrants there are within that space. Don't want to belabor the point, but we're in the midst of 80+ population surge at a time when supply has just completely fallen off a cliff. And it's probably not coming back. You made a good point earlier that it is a low barrier to supply market, but right now you just can't make it pencil. So you have this nice 2 to 3 year window where we're expecting NOI growth for high quality senior housing portfolios, probably double digits over the next few years.
It's like your number one growth area.
Correct.
In NOI projections.
Exactly. Yeah, it's that compares to like 3% for average commercial real estate. So that's attracting a ton of debt and equity capital. Even data centers is, we already touched on that, but demand there is exceptional. Fundamentals are exceptional, and we're still expecting mid-single digit growth. So,
but data centers are a little polarizing. People are in it, but it's gotten so big that there's just as many people who are very excited about it as others are who don't and can't necessarily see an exit on $1 billion 3-building campus. It'll probably happen, but it's a complicated asset class relative to healthcare.
It's also just becoming incrementally more difficult to build with some power constraints, and seeing you have to move into more secondary type markets. We literally can't build quick enough to capture the demand. But to your point,
if you can deliver a powered hyperscale data center, you'll get a lease with one of the hyperscalers.
Exactly.
It's easy, right?
Yep.
Tom, I'd like to just comment. I think you're spot on with your stats, and we do an annual investor survey. Typically, we get in excess of 300 respondents back, and 85, 86% said that they plan to increase their investment in 2026 over 2025. So the sentiment is echoing the broader sector, and it continues to push that if our volume then is needs to increase to then meet those demands, plus then some new entrants that might not be a part of our survey. It's certainly going to create more demand versus supply imbalance, which it's historically been where we've had less supply than there is demand. There's always been more capital that wants to step into our place than there is product. When you think about it, the health systems own, generally speaking, across the U.S., about 65% of the real estate. So then the REITs then have, typically aren't sellers, have been net sellers over the last couple of years. But the actual tradable assets is just a small percentage. And so those that can go ahead and acquire portfolios of scale or can do the one-offs and then grow to a portfolio premium. Keep in mind that the average transaction is probably 15, 20 million bucks, that they should be rewarded because a lot of those big institutional investors don't want to get out of bed unless it's for a $200 million, $500 million deal. And that's the way that they can all of a sudden justify the ramp up of overhead and all their people that are going to be dedicated to the space. They need a large splash to make it possible.
I think that's one thing that does concern me is actual deal flow in our sector, because I personally think so much new capital is coming in and looking to place large chunks of capital and looking for portfolios. And it's surprising to me, we had a thesis that over the last 24 months, healthcare systems were going to shed a lot more assets. And it turned out to be the complete opposite. We've seen more ROFRs get exercised than we've ever seen before. And so, initially we're like, okay, they need liquidity. There's a lot of changes in the administration, particularly to Medicaid, Medicare, payments, insurance. I mean, the whole landscape is starting to shift. And so we thought that volatility would cause health systems. And a lot of health systems we talk to are saying, hey, we're putting some brakes on. We're not starting new construction, this or that. But then at the same time, all these portfolios that are trading, it's an enormous amount of ROFRs getting exercised. So it's a bit confusing right now.
Why do you think that is? I'm curious your thought, or anybody.
So I think that there were a couple of things that happened. So look, the pandemic, their number one concern was taking care of the patients, taking care of our American citizens and making sure they're healthy. So all that future growth on the outpatient side of things was put on pause. You then, look, health systems tend to be a little bit slower than, say, corporate America for making business decisions. So by the time they got around to refocusing back on their outpatient real estate, you're now looking at really 2022. And at that point in time, the inflationary environment had already kind of taken its hold. And so they got really large sticker shock for building new outpatient medical. Generally across the country, call it 70% premium to the existing rental rates. And so that then made them step back and say, maybe we don't need to do this development. Let's kind of relook at our existing holdings, figure that out. And so fast forward to kind of where we are here today, they know that they need to grow outpatient. They need to decant the campus in some respects. They also view that because they need to control that real estate that's on their campus for the foreseeable future, they're looking at replacement costs that is well exceeding that. And so they say, well, I can buy it back now for $400 a foot versus build it for $600 a foot. And then I can also then protect my land on the campus. We are seeing on the flip side, though, some of these groups, I can touch on the Cleveland Clinic, but I can also touch on several others that we're having conversations with that are somewhat capital constrained because they're building huge new bed towers. And they're saying, look, we've historically developed all of our real estate. We now need to turn to a third party to do some of these outpatient things just because it's going to be delivered on time and close to on budget, and we can then spend $1.5 billion on a new bed tower.
So with aging population, continued move to outpatient, what do the next few years look like in terms of new supply and how that's going to come out from the health systems? I know we just touched on a little bit how maybe they're pulling back, but they're trying to move things out because they've got these site neutral issues now and some other things that would be good for them. And so what does it look like from maybe some of the conversations you're all having with those folks?
Yeah, I think we're going to have to do new development because if you look at occupancy across the U.S., I think we're at
92, 93.
93%.
And it's always like that.
Yeah, it's always like that. It's been very stable. And don't quote me on these numbers, but I think GDP spend on healthcare is going from like 17 to 19%.
Yep, you're right.
It's the aging population, all the trends are 100% in our favor. But when you look at so much of the existing medical product that's out there, it's old and it's, floor plans aren't great, low ceilings. In California, there's major earthquake issues. Like there's buildings where we look at where tenants are, hey, we can't be in here much longer because of all the earthquake renovations that have to go through, and that costs millions and millions of dollars. So I think we're going to continue to see a lot more development happening. It hasn't happened to the scale we would all have liked, and we're always a little bit more constrained, right? Because in our sector, we don't go spec. Typically we can't even get financing unless we're 50% pre-leased. And so we've had these constraints, and then in many states we have to go through additional approvals, and it's not easy to build medical assets, but I think it's going to have to happen.
If you look at like just the awards yesterday, you saw a really nice mix of new construction and rehabs.
Right.
Right, and I'm not sure that there's a massive delta in the all-in cost at the end of the day. You probably can deliver a little bit quicker on the rehab, renovation side, but the costs are the costs. So from an underwriting perspective, I think what that translates into, when you look at, call it a mid-20s rent in, anywhere USA for an existing rent at lease expiration versus a new construction rent, anywhere sort of non-coastal USA in the $36 to $38 a square foot rent range, right? You're increasing 50% if you go build new. So I think it's pushing releasing spreads, assuming you don't have fixed price renewals, and it's increasing retention rates. So I think from an underwriting and performance perspective, if you've got the right mousetrap, the right location, the right set of services, the right sponsorship, you're going to have performance at your asset that should be improved in the mid to long term.
The other thing I'd like to kind of just touch on is that we've seen considerable consolidation in our space, and a lot of the health systems need to consolidate because then they also get some more negotiating power against the major payers on the commercial side. And so with that, and not only that, but they also from the overhead, just from the reporting requirements and so forth for the insurers, electronic medical records, all these other things, these smaller doc practices have decided to go and be more employed, to be entrepreneurial and own their own practice. And so sometimes they own these buildings spread out across the broader metro, and they tend to be more smaller assets. And the health system really wants the referral patterns that happen in a larger outpatient medical building. And so there is a rhyme or reason in where they can rationalize coming together and developing a new outpatient center, because then they can get you can see your orthopedist, the primary care, the same place as your orthopedist. Your orthopedist then has the ASC, and then they have the imaging, and then they have the PT all in one roof. And that patient capture then is no longer going to a third party. It's all staying within the health system. So I still feel that you can justify the premium that comes along with the new construction. But again, it's a case-by-case basis, but I don't think anything's stopping it because of the demographics are there to support it.
And I agree with a lot of what's been said here. The only thing I'll maybe note is, yes, we need new development. The demand is clearly there, but even when you have a tenant willing to pay, $40+ a square foot, the yields are still pretty skinny relative to the cap rate on that asset. So if you're looking at it from purely a real estate profit margin point of view, it is below average relative to other property types. And so I think there probably will be just a lid on development naturally as a result. And obviously, this isn't a spec business, but
your comparison is development yields versus as completed value?
Yes.
Okay.
Yeah, which obviously isn't always the way it's looked at from a health system point of view, but from a real estate investment lens, I think it matters, and so I think that will keep somewhat of a lid on development, which would be good in terms of existing owners of medical office real estate, and I think we are probably posed to see slightly better rent growth over the next 3 to 5 year period relative to what we've seen historically in this space.
I would certainly agree with that. I think from the yield on cost versus the exit cap rate, the rule of thumb has historically been basically 100 bips. I know obviously when we run some RFPs, they're truly built to core. I'm talking about, we just ran one and it was sub 6 cap on the yield to cost. And I think it just speaks to the lack of supply, that getting high quality new construction outpatient medical buildings with a investment grade credit that's in a key market, that if you can justify it and have that carry cost and it's pre-leased, we're seeing some of the LPs coming in willing to kind of almost price no spread between that, or 25 bips. And it's, yes, it seems like it's choke worthy, but the hope is that once you get in with that system, that there's going to be more opportunities. There's going to be, you're going to become a preferred partner of theirs. So it can't always just be looked at from the narrow spread on one transaction. There's other things that can come to fruition alongside that relationship.
Yeah, 100% agree with that. We even see that with the large REITs. A lot of them are, it's more relationship management on the development side rather than juicy profit margins. So I agree with that point.
What are you guys excited about for 2026 as we're already a month or so in? What gets you going this year in this space?
I think the big, exciting, really strategic, structured transaction that hasn't been around for a few years, and is they're always they're fun deals to do. So that I think is really exciting, and the spinoff that comes as a result. We're in the transaction business, so it keeps us busy.
Are you finding
That's
bidder pools are a lot bigger? You're just showing them.
Great question.
People
Bidder pools in the last year.
Yeah.
I would say, so if you looked at like 2022, 2023, somewhat evolving 2024, you get a high quality asset, that you'd put out to market. You might get 5 or 6 bids at most. It has returned to, exciting levels where you get 15 to 20 offers. And what I think is really interesting, not just the total volume of bidders that are back, but the composition of those bids, right? So you'll see, let's just say you get 15 face offers. There'll be 3, 4, 5 bidders, sort of institutional asset managers that come with a separate account, a core fund, could be an insurance company, right? So they'll figure out where it goes at allocation committee.
Right.
But that really means that in effect, you've got those 15 offers come with 20 or 23 investors that sit behind them in totality. So it's a really deep pool.
We've actually started, and you guys probably know this, we go through some of these pools in different asset classes, and then you do a best and final, and then somebody keeps calling, and they keep calling and calling. It just shows me that things are happening again.
Yeah.
They're not just saying okay. I mean, they really want things. What about you, Samir?
I'm excited because we've got a couple of bazookas behind us right now, and we deploy a lot of capital. And we are portfolio building. We're building portfolios by buying portfolios, right? And so that gives us a flexibility to buy across the spectrum from core plus, value add to opportunistic, and really kind of put together a massive portfolio that over the next 24, 36 months we'll have a lot of optionality on, because it's not just the capital from the equity side, but as we mentioned earlier, the debt capital markets are going to start getting really interesting as well, right? So spreads have come in, but now, can you start looking at ABS structures? Can you start looking at other creative ways to really create juice behind some of these larger transactions? And we think that is happening already, and it's going to continue to happen. So this is a very exciting year for us.
Yeah, I'm excited for a large part everyone is here at the conference, because we're finally at a point where the window's opening, not only on the debt side, where pricing has started to come in, that we touched on it, the fundamentals in our space have not been stronger than they are today.
Yeah.
And this is really just a debt markets and capital markets issue on just a run up in interest rates, that a lot of people that bought in the peak are like, whew, my promote got completely washed away. And now we're starting to see some of the rent growth. We're starting to see some of these other things. We're starting to see the debt markets tighten from the spread, that finally they're like, wait, I might actually make money on my portfolio that I acquired in 2021 and 2019 in that vintage. And so I think it's just going to spur more velocity. We saw just even the velocity that was done at the end of last year. I think your team, I know our team, like our volume almost doubled between 24 and 25. I know we anticipate that only continue here in 2026. So look, I think we're all deal junkies. We want to do more deals, and we're happy to see what's on the horizon here.
Yeah, I think I echo a lot of those sentiments. It's healthcare in general is a very interesting sector. There's always going to be some surprise on the regulatory front or what have you. But just watching the transaction volume come back and debt financing be as available as it is today, it's a more fun industry when people are making money and everything's going well. So just seeing, we'll see if there's another deal like the Welltower one we saw last year. I think that would be that'd make for a fun year. So.
Yeah, and I think for me, I mean, we just continue to see new investors into the alternative space, into medical and other things, and we would suggest now that as it's been called alternatives, we think now it's as much core as the traditionals are because of the characteristics of the real estate. Certainly with medical office, the consistency of the occupancy, the WALTs, the credit tendency behind it, just the stability. So, I mean, it's more core than office, let me tell you. So, I mean, I think that continues to get our firm and us excited about the opportunities going forward. So, we're looking forward to 2026.
And to your point on that, I mean, we're talking to so many investors that have historically only been invested in traditional office, and given the challenges there, particularly in like suburban, lower quality office, they're looking to dip their toes into medical office. So that's definitely a trend we're seeing quite a bit of.
I don't know if we open this up for questions. I think we're done. I think the group would be happy to take a question or two from the audience. Mike, is that okay? Yeah.
Someone back there.
Yes, in the back.
Yeah.
Hi. What would you like to see from a general contractor that would make early budgets more bankable? Is it like a progressive design build, or like how can we support you better? We're not constantly doing wrong pricing.
No, I think the biggest thing is really on the provider side, really nailing down the scope. I think that's where budget creep naturally happens, is through change orders or from also a delay in being able to kind of lock down their GMP pricing. I know that it's tough because they're your tenant, but as much as you can kind of push them to decision making and either leaning on them from past projects or other things that way, where you can kind of be a value creation and bring that to the table and help save some costs and point to what their peer set is doing, because I think a lot of the health systems do look at what their peer set is doing. That gives them further comfort and conviction that if you can make their decision tree faster and more seamless, I think that's going to certainly help with the budget creep.
This isn't exactly an answer to your question, but sticking on that point, we've heard from a lot of diversified owners and developers that, in multifamily, construction budgets are moderating, whereas we're not, seeing that so much in medical office. My hunch, and I don't know this to be the case, but my guess is that your question suggests it, is that because you've got some of the things that, Brandon, you just talked about, because you've got generally a build-to-suit business that is open book, it's yield on cost, right? Everything just goes into a pot and you solve to a rent. You don't have as much oversight, or necessarily as much
Cost cutting.
Yeah,
value
as you
engineering.
do value engineering as you do in a speculative business where, every last dollar counts and your tenant isn't paying your overruns in other sectors.
Cool.
Anyone else? Oh, go ahead.
You got a big booming voice.
Yeah.
I got a big voice. So can you talk about, the change in, like, not the structure of, but, like, what's changed equity-wise now with funds that are being raised now and deploying now compared, because, a lot of the equity that was playing in 2021, they're refinancing out now, and they didn't get the returns that they wanted. So do they have cold feet? Is it new players? What's going on there?
I personally think our sector is going to be on fire in terms of new equity. From existing investors, new investors, institutional investors, private equity, sovereigns, pensions, like across the board, for some of the reasons we named earlier. Just because they know it's the stability of the asset class, the cash flow that's coming out of it, the high credit tenancy, the resilience in occupancy, and so forth. I think the biggest challenge is going to be what that net return is as cap rates compress and spreads compression starts stabilizing, and just growth, right? Because we're a boring 2 to 3% always. We're not going to have a 10% rent growth like in senior housing or getting to some of this other stuff. And number two is a lack of product. And I think much interest as we're going to get in, you're going to see a lot of players lose that interest when they can't cut much larger checks. But overall, I think it's an extremely positive thing for the sector and the industry, and we're going to continue to see a lot more institutional capital flow into here, especially with office just being upside down. They have to find a home.
And I think the other thing is that Samir and his peer set were out gallivanting across the globe, telling the story about seniors housing, telling the story about outpatient medical, that it used to be, well, what is that?
Yep.
When you talk to a foreign investor. Now they already know what it is. There already been white paper in it. And those that were sidelined, they were also then raising capital for the existing investors that have been playing in our space. So I think when you have that coupling effect of now having it that the alts are in line, as Don just touched on, with the core asset classes, and you still don't have all the major players that are investing in those four in our space, and then you have all the foreign capital that's also been coming in. Like, it's just a recipe for a very successful investment period on the horizon.
The challenge is just getting portfolios that are large enough for these players, because they don't want to do one-offs. They want to do 300, 400, 500 million.
We're happy to
I know you
volunteer
guys
and
can.
take care
I
of
know
some
you guys can do
monetizations
that.
for any health systems out there.
Yeah.
If you want it, or owners, but no, that is the constraint, is the volume.
Yeah.
Anything else? Well, thank you for listening to this group, and thank you all for contributing. Appreciate it.
Thank you.